If you just turned 65, or someone you love is about to this year, stop for a moment, because this could be worth over $1,000 to you. There are 3 specific bills that quietly stop being owed the day you cross that birthday. Real money. Often more than $1,000 a year. And right now, that money is sitting in the pockets of the IRS, your bank, and your county property tax office. And here's the uncomfortable truth: none of them have any real reason to walk up to you and say, by the way, this is yours to take back. So here's my promise for the next few minutes. First, I'm going to walk you through 3 dangers, 3 quiet ways the system keeps charging you for things you stopped owing years ago. Then I'm going to hand you 5 clean, simple solutions, 5 moves that protect the money you spent a lifetime building, without putting a single dollar at risk, and without making you learn anything complicated. The IRS will not tell you this. Your bank will not tell you this. And your county clerk certainly won't either. So stay with me all the way to the end, because the best part is saved for last, and almost nobody is ever told this for free. Before we go further, let me put your mind at ease about one thing. I'm not selling anything. I'm not here to frighten you. I'm just a retired fellow sitting at a kitchen table, writing down exactly what I wish someone had sat me down and explained the day I turned 65. Everything I say is grounded in real federal law, real recent numbers, and real things you can look up yourself today. And if I ever get a number wrong, I'll correct it. Let me earn your trust by being careful, and let me show you where the money is hiding, so you can go quietly take it back. Here's the first danger, and it surprises almost everyone I talk to. The IRS keeps collecting taxes from you long after you've earned the right to stop paying them. And I'm not talking about anything shady. I'm talking about legal breaks written directly into federal tax law that almost nobody over 65 ever claims, simply because no one told them the boxes existed. Let me walk you through it slowly. When you file your federal return, the IRS gives you 2 ways to lower your bill. The first is the standard deduction, a flat dollar amount they subtract from your income before calculating your tax. The second is itemizing, where you list things like medical bills, charitable gifts, and mortgage interest. But for people over 65, there's an extra amount sitting right there on the page, hidden in plain sight. It's called the additional standard deduction. On the most recent tax form, it quietly added about $1,950 per qualifying person if you're married filing jointly, or about $1,550 if you're filing single. So if both you and your spouse are 65 or older, that's roughly $3,900 a year, sitting in a spot the IRS will not add to your return unless somebody checks the boxes on the form. And that's on top of a second break almost no one uses. The IRS lets you deduct medical costs that go above 7.5% of your adjusted gross income, that's your income before the standard deduction is applied. Most retirees never claim this, because they assume their medical costs are too small, or they never kept the receipts. But for a typical older couple, Medicare premiums, supplemental insurance, prescriptions, dental work, hearing aids, eyeglasses, and regular doctor visits add up fast. They almost always push you across that 7.5% line. And once you cross it, every dollar above that line is a dollar the IRS no longer has the right to bill you for. Then there's a third break most folks have never heard mentioned at all. The age at which the IRS forces you to start pulling money out of your traditional retirement accounts, what they call required minimum distributions, or RMDs, has moved. It used to be 70.5, then 72. Right now, it's 73. And soon it rises again to 75. That means you may have several more years, between 65 and 73, where the IRS is no longer reaching into your retirement account and demanding a slice every year. Your money can keep sitting there, growing tax-deferred, untouched. Here's the anchor I want you to hold on to. Look up IRS Publication 554, the Tax Guide for Seniors. It's free. It's right on the IRS website at irs.gov. It lays out every single break I just mentioned, in plain English. The IRS wrote it. They consider it official instruction. But they will not mail it to your door, and they will not call to walk you through it. The IRS isn't your enemy here, and they're not hiding anything, but they're enormous. They process over 150 million individual returns a year. They simply don't have time to call every senior and say, "Hey, you stopped owing us $3,900 last year. So please don't just do nothing. Pick up the phone, talk to a tax preparer, ideally one who specializes in senior returns, or do your own return. Either way, check the senior boxes on the form. They're there for a reason." Now, here's the second danger, and this one is sneaky, because the money leaves your account in tiny, quiet amounts you almost never notice. Your bank keeps charging you fees that are legally supposed to be waived the moment you turn 65, and your bank is not going to tell you. The mechanism is the monthly maintenance fee. Almost every big retail bank has one. Walk into a Chase, a Bank of America, Wells Fargo, or a regional bank like PNC, TD Bank, US Bank, Regions, or Fifth Third, and you'll find a basic checking account that costs somewhere between $10 and $15 a month, just for the privilege of holding your money there. That's $120 to $180 a year walking straight out the door. And the bank makes it feel normal. They call it a service fee. They tuck it into your statement in small print. They don't flag it. They just let it slide, month after month, for as long as you're willing to pay it. But here's what they don't tell you at the teller window. That same bank has, somewhere in its own paperwork, a clause that waives that fee for customers who are 65 or older and meet a small set of quiet conditions. Some banks waive it for any senior account holder, with no minimum balance at all. Others waive it as long as you have direct deposit of your Social Security or pension. A few will waive it if you simply ask. The conditions aren't hard, they're tiny. But the bank won't volunteer them. They won't hang a poster in the lobby. They won't mention it when you open the account. They'll happily let you pay $10 or $15 a month for years, because to them, that's $1,000 of free revenue from a customer who never asked for the waiver. Let me give you an anchor here. In 2023, 3 big American banks failed within weeks of each other: Silicon Valley Bank in March, Signature Bank in March, and First Republic in May. The FDIC, the government agency that protects money in bank accounts, ended up paying out insured deposits to over 500,000 customers across those 3 banks, about $162 billion in total. After that, every big bank in America quietly tightened its rules on which accounts it keeps open, especially for older customers with steady balances. Some banks are now closing long-standing senior accounts altogether. If the balance drifts below a certain number, they mail a letter giving you 30 or 60 days to move your money, and they don't really explain why. The real reason is that your quiet $12 a month just isn't worth as much to them as it used to be. So please, don't just do nothing. Walk into your branch this month. Bring a piece of mail that proves your age. Bring your Social Security award letter if you have it. Sit down with someone and say the words, "Do I qualify for a senior fee waiver?" The person behind the counter has the form. They've probably waived this fee 100 times. They're just waiting for you to ask. And here's the third danger: this one lives in your mailbox, once or twice a year, in a thick envelope from your county that you've probably been paying without really looking at. Your state and your county quietly keep billing you for property taxes that have a senior exemption built right in, an exemption you almost certainly never applied for. Here's how it works. Almost every state in America has some form of property tax relief for people over 65. Some states freeze the taxable value of your home the year you turn 65, so even as your house rises in market value, your tax bill stays flat. Some states knock a flat amount, often anywhere from $25,000 to $75,000, off your home's assessed value before they calculate the tax. Some let seniors defer the entire property tax bill until the home is sold, as a quiet lien against the property. And a small number offer outright homestead exemptions where the state actually sends a real check back to you. Every one of these programs is real. Every one is written into state law. And almost none of them is automatic. Here's the part your county clerk won't call to explain. In most places, the senior property tax exemption is something you have to apply for. There's a form. There's usually a deadline, often early in the calendar year. You bring proof of your age, proof you own the home, and proof you live in it as your main residence. The clerk's office will accept the form, smile, and process it, and starting with your very next bill, the exemption quietly subtracts thousands of dollars from what your county is allowed to charge you. But that office processes hundreds of thousands of bills a year. They don't have the staff to call every senior homeowner and say, "Did you know this was sitting on the table for you?" So they just mail the full bill, collect the full bill, and the senior pays the full bill, year after year, because nobody ever said the words, "Do I qualify for the senior exemption, and what's the deadline?" Here's your anchor. Search your state's name along with the words Senior Property Tax Exemption. The first result is usually the official state website. For example, in Florida, the homestead senior exemption is $50,000 off the assessed value for any owner 65 or older. In Pennsylvania, the senior real estate tax rebate program can send a check of up to $1,000 a year. In Texas, the homestead exemption for those over 65 freezes the school district portion of your property tax at the prior year's amount. In New York, the enhanced star exemption reduces the taxable value of a senior's home by tens of thousands of dollars each year. Each one is real. Each one has paperwork. Each one has money on the table for you. And some of you will say, "My state doesn't have that." Maybe not, but your city or county might. If your search comes up empty, call the county assessor's office. 2 questions is all it takes: do you have a senior exemption? And, what's the deadline? Don't just do nothing. The bill is real, the exemption is real, and the only thing standing between you and the savings is one short phone call. So now you understand the 3 dangers. The IRS keeps collecting taxes for breaks you never claimed. Your bank keeps taking a small monthly fee you could have waived. And your county keeps mailing the full property tax bill while the senior exemption sits right there on the shelf. The pattern is always the same: large institutions, with very small reasons to point it out, quietly billing you for things you no longer owe. Which brings us to the question you've probably been waiting for: how much is too much to keep in a regular checking account? The honest answer is more than $15,000 to $25,000. That's roughly 3 to 6 months of living expenses for a typical retiree: food, utilities, medicine, and a few modest extras. Anything above that range shouldn't be sitting in that one checking account, because at that size, 3 things start happening at once. The bank starts tracking it differently. The FDIC only protects up to $250,000 per depositor, per bank, so anything above that line goes unprotected in a quiet failure. And the checking account earns next to nothing, often less than half of 1%, while the cost of living keeps rising around 3% a year. Which means the money in that account is slowly shrinking in real buying power every single month, even though the number on the screen never changes. And that's where the 5 solutions come in. Let me walk you through them, one at a time, in plain language. Number 1, move the overflow into a high-yield savings account at an online bank. A high-yield savings account is just a regular savings account that pays you real interest instead of almost nothing, offered by banks that don't have expensive branches to maintain, so they pass the savings to you. Most well-known online banks right now are paying somewhere around 4 to 4.5%. That's not a teaser rate, it's the published rate right on their account page. Compare that to the typical big bank checking account, which pays essentially zero and charges that monthly fee we just covered. On $20,000 parked safely, 4% is about $800 a year paid into your account, federally insured up to the FDIC limit, with your money staying liquid. Liquid just means you can move it back to checking in 2 or 3 business days. The honest trade-off: you can't walk into a branch, you do everything online or through an app, and transfers take a day or 2. So this isn't for the bills you pay next week. It's for money you won't need for 90 days or more. Number 2, ladder part of your cash into U.S. Treasury bills, bought directly from the government through a free website called TreasuryDirect, which lets you buy them without a broker and without a commission. A Treasury bill, or T-bill, is just a short-term loan you make to the United States government. They pay you back with interest in a few weeks or months. And the United States has never missed a payment. That's not a sales pitch, it's the factual history of every T-bill ever issued. Right now, T-bills are yielding somewhere around 4 to 4.5%, depending on the term. And here's the benefit most retirees never hear about: the interest on a T-bill is free from state and local income tax. Federal tax still applies, but if you live in a state like California, New York, or New Jersey, that state tax-free piece can be worth an extra 1 to 3% compared to a regular bank account. The honest trade-off: T-bills come in fixed terms: 4 weeks, 13 weeks, 26 weeks, 52 weeks. If you need the money before the term ends, you have to sell it on the open market, and the price can move against you. So this is for money you're confident you won't need for at least 3 months. Number 3, look seriously at Series I savings bonds. A Series I bond, often just called an I bond, is a special savings bond the government issues that keeps up with inflation. Twice a year, in May and November, the Treasury resets the rate based on official inflation numbers. When inflation rises, your rate rises. When it falls, your rate falls, but it never drops below zero. You will never lose money on an I bond. Right now, the composite rate is somewhere in the range of 3.5 to 4.5%, depending on when it was purchased, but it changes every 6 months, so always check the current rate on TreasuryDirect before you buy. There are 2 honest trade-offs. First, there's a hard cap, $10,000 per person, per calendar year. That's per Social Security number, so a married couple can put in $20,000 a year between them. Second, if you sell before holding it a full 12 months, you lose the last 3 months of interest as a small penalty. After 12 months, you can sell anytime, no penalty. So treat I bonds like a 1-year plus parking spot for savings you'd like to see grow with inflation, rather than get quietly eaten by it. Number 4. If you have a lump sum you won't touch for 1 to 5 years, consider brokered certificates of deposit, purchased through a brokerage account. A brokered CD is just a regular bank CD, a certificate that pays a fixed rate for a fixed term, except you buy it through a brokerage firm online instead of at a branch. Why does that matter? Because a brokerage can split one large purchase into pieces and place each piece at a different bank. Each piece sits fully FDIC insured up to the $250,000 limit per bank, but the whole pile is spread across many banks, so no single bank failure can sweep it all away. That's the structural fix for the FDIC danger we covered earlier. You can put a large sum to work this way and sleep well, because each piece is independently insured. The honest trade-off: brokered CDs aren't liquid. If you need the money midterm, you have to sell on the brokerage's marketplace, and the price can move against you. So this is for money you truly won't need for the full term, often 1 to 5 years. And the yields right now are competitive with T-bills, often around 4 to 5%, sometimes a bit higher for longer commitments. Number 5, open a money market fund inside a brokerage account, and keep part of your safe cash there. A money market fund is a pooled investment account that holds short-term government and corporate debt, and it behaves almost exactly like a checking account. You can usually write checks against it, transfer out in a day, and the value of your share barely moves. The difference is the yield. Right now, top money market funds are paying somewhere around 4 to 4.5%, comparable to the best high-yield savings. Here's the honest part: a money market fund is not FDIC insured. It's not a bank deposit. It's a fund held by a brokerage firm, governed by SEC rules that require it to invest only in short-term, high-quality debt. If something truly catastrophic happened, you could lose a fraction of a cent per share. In the entire history of money market funds in the U.S., that has happened only twice, in very unusual circumstances. That tiny risk is the trade-off for the yield, and it's far smaller than the real risk of leaving too much in one checking account earning nothing while inflation runs around 3% a year. The other honest trade-off: it's a brokerage account, not a bank account, no FDIC insurance, no branch, everything on a website or app. But for cash you want earning real interest while staying spendable within a day or two, this is one of the cleanest tools on the table. Let me tie all of this together, because there's a single thread running through every danger and every solution, and I want you to see it clearly. The current system quietly takes from you through 3 channels at once. Watching, that's the IRS keeping an eye on what you owe and what you haven't claimed. Shrinking, that's your bank slowly skimming fees it shouldn't, and inflation eating the value of cash that just sits there. And unprotecting, that's having more than the FDIC limit parked in one place, where one quiet bank failure, exactly like 2023, could sweep it all away overnight. When you make the 5 moves I just walked you through, you are not putting your money at risk. You are removing risk that was already there. You're turning a near-zero checking account into 4% plus cash spread across several safe instruments. You're turning an unclaimed senior tax break into real money back in your pocket. You're turning a waivable bank fee into a clean zero on your statement. And you're turning an unpaid property tax exemption into a smaller county bill every year. You are not gambling. You are not chasing yield. You are removing silent drains that were already pulling from your account, and putting each dollar where it earns the most while facing the least. That's what a wise neighbor does. That's exactly what I wish I'd done at 65. Now let me ask you one small favor before we wrap up. Today's video isn't really for me, it's for someone you know. Think of one person you love who's over 60, who worked hard their whole life, who still keeps most of their money in one checking account at one bank, and who has never once been told any of what you just heard. Maybe it's your mother. Maybe your brother. Maybe the fellow at church who drives the pickup and still writes checks at the diner. Pick that one person, sit with them this week, and show them this video, or better yet, just sit beside them and go through it together. You'll be doing for them exactly what I wish someone had done for me at 65. They'll save real money. They'll sleep a little better. They won't thank you dramatically, but you'll see it on their face the moment it lands. Take care of that money. It earned its rest. And I'll see you in the next one.